The application of duration analysis in managing bank risks. Welcome to our deep dive into the intriguing world of duration analysis and its pivotal role in managing bank risks. In the financial sector, understanding and mitigating risks is crucial. Duration analysis offers a sophisticated way to measure interest rate risk, one of the most significant challenges banks face today. Let's unravel this concept and see how it's applied in banking risk management. Understanding duration analysis. Duration analysis is a financial tool used to assess the sensitivity of a bank's assets and liabilities to changes in interest rates. It measures the weighted average time until all cash flows from an asset or liability are received. Essentially, it predicts how the price of bonds and other fixed income securities will fluctuate with changes in interest rates. Why duration matters. The reason duration is so crucial in banking is because of the mismatch that often exists between the maturities of assets and liabilities. A bank might have loans, assets, that are set to mature in 30 years, while owing deposits, liabilities, that could be withdrawn in the next month. This presents a significant risk if interest rates were to change. Application in risk management. Duration analysis is a strategic tool in the toolbox of bank risk managers. Here's how it's applied. Gap analysis. Banks often use duration gap analysis to evaluate the difference in the duration of assets and liabilities. Simply put, if a bank's liabilities are more sensitive to interest rate changes than its assets, the bank could lose money if rates rise. Duration gap analysis helps in identifying this risk and taking mitigative steps. Asset-liability management, ALM. Through duration analysis, banks can manage their asset and liability durations to achieve a desired level of interest rate risk exposure. For instance, by altering the mix of fixed and variable rate loans or investments, banks can adjust their duration to match their risk tolerance. Hedging strategies. Banks also use duration analysis to devise hedging strategies that protect against interest rate changes. This could involve using financial derivatives like interest rate swaps, futures, and options. By understanding the duration of their portfolio, banks can select the most effective instruments to mitigate potential losses. Implementing duration analysis, a closer look. Implementation begins with calculating the duration of each asset and liability. This involves detailed financial modeling and analysis. Banks then aggregate this information to understand the overall duration of their portfolio. Scenario analysis plays a pivotal role here, where banks simulate various interest rate movements and observe the potential impacts. This proactive approach allows banks to adjust their asset-liability composition before market changes can adversely affect them. Challenges and considerations. It's important to note that while duration analysis is powerful, it's not without its limitations. Assumptions made about cash flow timing and interest rate changes can introduce inaccuracies. Moreover, in today's volatile financial markets, predicting interest rate movements with high precision remains challenging. Real-world application. Consider a scenario where a bank finds its assets are too sensitive to interest rate hikes. By shifting some of its portfolio into shorter duration securities or attracting more fixed-rate deposits, the bank can reduce its overall duration, thus lowering its interest rate risk. Conclusion. Duration analysis is a vital tool for managing the complex landscape of bank risks. By effectively applying duration analysis, banks can navigate the treacherous waters of interest rate fluctuations, ensuring their stability and profitability in the long term. Want to learn more? Claire Trithel on LinkedIn.